In October 2005, at the peak of our last housing bubble, Ben Bernanke, who was then the chairman of the Federal Reserve Bank, said not only are we not going to see a housing bubble burst, we don't even have a housing bubble.
So we have so many economists coming on our air and saying, oh, this is a bubble and it's going to burst and this is going to be a real issue for the economy. Some say it could even cause a recession at some point. What is the worst case scenario if, in fact, we were to see prices come down substantially across the country?
Well, I guess I don't buy your premise. It's a pretty unlikely possibility. We've never had a decline in house prices on a nationwide basis.
3 years later, Lehman Brothers collapsed and our financial system almost failed. And then 7 years later, in 2012, that was when we finally saw the housing market hit the bottom. Now here we are in 2023, and Jerome Powell, who is today the chairman of the Federal Reserve Bank, is saying that yes, we have some issues in the housing market, but they're contained.
The housing market needs to get back into a balance between supply and demand. We're well aware of what's going on there. You know, from a financial stability standpoint, we didn't see in this cycle the kinds of poor credit underwriting that we saw before the global financial crisis. Housing credit was much more carefully managed by the lenders.
He's right. We don't have the same subprime lending today that we had before the 2008 crash, but that doesn't mean we don't have any risks to our housing market or our economy. Like Fortune magazine recently said that we are entering a housing market reset. In 2020 and 2021, we saw the housing market boom because everybody wanted a home that they could now work from home from, and on top of that, we had the lowest mortgage rates ever, so everybody was trying to buy a home. But things started to change in 2022 because of how fast interest rates rose. In the beginning of 2022, you could buy this home for $400,000 and pay $1,500 a month. By the end of 2022, homeowners were saying, wait, I want to buy the same home that my cousin bought in the beginning part of 2022. Now I have to pay a little bit more. Fine, I have to pay $428,000 in December of 2022 versus the $400,000 you could have bought it for in January of 2022 because we saw home prices rise by around 7% in 2022. But the big difference was now you're going to have to pay $2,500 a month as opposed to the $1,500 a month your broke cousin Bunty was able to get it for because they were able to secure a lower mortgage rate. These higher mortgage rates made it much more expensive to buy a home, and on top of that, home prices also rose. Now here we are in 2023. Interest rates will continue to rise, and the 2022 housing market slowdown is spilling over. But if you really want to dive into what's happening in the housing market, you have to understand what's going on with home builders. And the big news for me in 2022 was when Toll Brothers reported that home buyers were canceling 20.8% of their new home contracts. What Toll Brothers said was that in July, August, and September, not only did they see a 60% drop in new contracts being signed for homes, but 1 out of 5 of the contracts that they did have signed, home buyers just walked away from. And some of these home buyers walked away from their earnest money deposits. They walked away from the cash that they put down because they couldn't afford the higher monthly payments. That was the news that we got in 2022. Now, in the beginning part of 2023, KB Homes gave their report on what happened in October, November, and December of 2022. And what they said was they saw a massive uptick in the cancellations. They didn't see a 20% uptick in the cancellations or a 30% or even a 50% or even a 60%. But they saw 68% of their gross home orders canceled. Let me read you a little quote from what the CEO of KB Homes had to say about it. High mortgage rates and persistent inflation together with an uncertain economy have made home buyers more cautious since the middle of last year, 2022. There are essentially 3 different factors coming together right now which are putting downward pressure on housing market prices. Now, we've been covering all of this in market briefs, including the stories from home builders. If you want to stay up to date on what's happening in things like the housing market, our economy, the stock market, crypto, and the global economy, Market Briefs is a super easy to read email and it's completely free, where every day my team is breaking down what's happening in the financial markets into a fun, witty, and easy to read newsletter. So if you want to join Market Briefs, it's completely free. I'll put the link to how you can join Market Briefs for free down in the description below. The 3 factors that are contributing to the downward pressure on housing prices are 1, high inflation, number 2, higher interest rates, and number 3, a slowing economy. The high inflation means I don't want to go out and buy a home right now because I can't afford the higher prices of homes, especially because I can't even afford the higher prices of eggs. And I should also mention that these high inflation numbers that we're still seeing is contributing to a slower economy because now the prices of everything is rising so fast that people are having to cut back on their spending, which is contributing to a slower economy. Higher interest rates means that buying that $400,000 home you were thinking about buying is getting more expensive, not because the home price is rising, but because the cost of borrowing that money is rising. And I should also mention that these higher interest rates are putting downward pressure on the economy, because when interest rates go up, the cost of borrowing money goes up, which slows down spending. Less people are likely to refinance and spend money. Less people are likely to go into debt on their credit card, even though we are still seeing credit card debt rise. But it means that your interest payments on your credit card debt is rising. Less people are likely to go out and borrow money to get a car because the cost of borrowing money goes up. But it also makes homes less affordable, even if home prices don't change, because you have to pay more money to borrow the money to buy that home. That puts downward pressure on housing prices. And a slowing economy means I might not get my raise or my bonus or my promotion that I was hoping for because my company is not doing as well, or if things get even worse, this could also mean that I might get laid off or I might lose my income. And in that case, again, this puts downward pressure on housing prices, because if incomes are not rising, if people aren't making enough money, or if people lose incomes, well, then people don't have the ability to buy more homes, and people don't have the ability to keep making the housing payments. So this also has downward pressure on the housing market. These three factors are why we saw home sales drop almost every single month in 2022. It started with high inflation. And then in the second quarter of 2022, we added this, the higher interest rates. And then further on into 2022, we kept seeing the economy slow even further. Now here we are in 2023, we have less of this, although we still have extremely high inflation. We have high interest rates, and we're seeing this, the economy slow down even faster. Now there's two things that I want to caution you with here. Number one, with everybody worrying about a potential housing market crash, the first thing that I want to say is remember the past. When the 2008 crash happened, it started in 2005, it didn't bottom until 2012. It took 7 years for that real estate cycle to complete, from going to the peak to going to the bottom. Real estate crashes do not happen overnight. They happen very slowly, and real estate prices move slower on the way down than they do on the way up, because sellers are much more likely to raise the price of their home than they are to cut the price of their home. So you got to understand that. Second, you got to understand that interest rates, while they are scheduled to go up right now, they can always change, because the Federal Reserve Bank is the entity in charge of interest rates. And as of today, as of the time of me recording this video, they are saying that they're going to continue raising interest rates throughout 2023. And even if they stop raising interest rates in 2023, they have said time and time again that they do not want to cut interest rates. However, you have to imagine that if the Federal Reserve Bank really started to see downward pressure on the economy, and they started to get really worried about layoffs, they started to get really worried about everything going on in the economy, the housing market, then they could force them to reverse course on interest rates. And just think about what that would mean. If the Federal Reserve Bank were to cut interest rates back down to zero and mortgage rates went back down to 3% tomorrow, what would happen? Well, everybody would want to go out and buy a home again, which would put upward pressure on home prices again. So we have this interest rate factor where we don't know what the Federal Reserve Bank is going to do. As of now, they keep saying that they're going to raise interest rates. If they keep raising interest rates, you bet that that's going to put downward pressure on the economy, and you bet that's going to put downward pressure on the housing market. The reason why they have to keep raising interest rates is because we still have this very high inflation. Now, it's kind of a double-edged sword here, because this high inflation is slowing the economy, and the higher interest rates are also slowing the economy, and both of these things are putting downward pressure on the housing market. However, if inflation doesn't get under control, then we have much bigger issues on our hand, where then we could risk things like hyperinflation, we risk a currency crisis. This is why the Federal Reserve Bank has to keep raising interest rates, at least as of now, but things could change. This is why I put this little asterisk here, because you have to understand that interest rates will play an effect on housing prices, and the Federal Reserve Bank, as of today, says that they're not going to be cutting interest rates in 2023, but that doesn't mean that they won't. This is where understanding that if there's too much downward pressure happening on the economy or the housing market or something else, this could force the Federal Reserve Bank to pivot and change course. So what does this mean for you? Well, if you're looking to buy a home, make sure you're buying something that you can actually afford, not something that you're going to stretch yourself too thin to buy, because if home prices fall, you don't want to be underwater on a property that you can't afford to make the payments on. And second, Well, if the economy continues to slow, if we continue to raise interest rates, it will probably create more opportunities. And the opportunities will be able to be capitalized on by the people who are prepared and the people who are financially educated. What does that mean? Be prepared, meaning put some cash aside to protect you, and then to be able to capitalize on investment opportunities that might come your way. And financially educated means, well, knowing how to invest, because if you have the money but you can't see an opportunity, you're not going to be able to capitalize on the opportunity. So you have to be prepared and you have to be financially educated. And we try to keep you educated with market briefs. It's a free resource for you, but you have to work on being prepared for yourself right now, which means cutting some of your expenses and working to earn more money so you have some extra cash to take advantage of opportunities that might come your way. What wealthy people do is they make money, and then some of this money is going to be for their spending purchases. Some of this money is going to be invested, and some of this money is going to be saved. But they have a system that tells them every time they get paid how much money is going to be spent. That way they don't